we're now branching into the South African market, not ideally or specifically the South African market, but however, the African market. So it's something quite interesting, and I believe most of us will really enjoy. And yeah, it's something that it's just going to be interesting. That's one thing I know. So just like every day, I've got my pen and paper, I've got my notepad right with me. So I'll be taking a lot of notes. So guys, with that being that, Mr. Timish, I believe I can go for it. I'll just invite a few more people, and then I believe they'll find us in progress.
Okay, thank you so much, Mr. Ben. We can proceed. And by the way, guys, we are going to have a very wonderful session today. It's going to be extremely powerful. South African economics is something very, very wild. But you guys asked for it, so we give what the people ask for. That's who we are at the end of the day. Let's just share my screen and see what we can do here. Okay, so I do hope that I am audible enough. I will just start from the beginning here. Okay, I think we're ready to rock and roll, guys. So, hopefully everyone can see my screen. I think it's still pitch black. It's just ready to. Okay. Let's do this. Okay. So welcome to another episode or another, we could call it an episode, but we do this every single week, every Thursday. Although today there's been an exception. We had to do it on Monday for various due to unforeseen circumstances. However, we are here and we are here to deal with a very important topic, which is South African fundamentals. So moving on. This is a very, very interesting topic to really discern. So today we won't be looking at upcoming events because first of all, it is approaching, it is basically month end. Right now, it's almost month end. So not a lot of high impact events do happen in this time period. However, it is important to really be aware with what is happening around South Africa's economy, in particular, what's happening in the JSE, right? And we're going to be looking at that very shortly. Right, what we see here is South Africa's stock market, so to speak, our stock market index. It's a JSE 40 index, top 40 companies on the JSE, the Johannesburg Stock Exchange. And what is happening here is in blue, we have government bond yields. So 10-year government bond yields in South Africa, South African 10-year government bond yields. This is the interest rate on government bonds, which basically is the interest rate of the real economy in a nutshell. And what we're seeing here is a rapid decline in these interest rates which has favored the South African stock market, because that means that a lot of investors can borrow at cheap, right? They can borrow at lower interest rates. So the lower the yield, the higher the stock price goes in a perfect economy, right? We live in an imperfect economy. And what happens is this relationship is not always correlating with one another. Sometimes this relationship is positively correlated, sometimes it's negatively correlated. It really depends on the time and the circumstances around the market at that moment. But what is happening here is that the South African economy is basically saying that, okay, the central bank has to cut rates sooner rather than later. South Africa's central bank is almost forced to cut interest rates the next time we have our meeting. We haven't cut interest rates yet, although the Reserve Bank governor has indicated a willingness to cut interest rates into the foreseeable future, although the chances of those interest rate cuts are higher because the market is anticipating this, which is what we are seeing with the government bond yield. And it's exactly why the market has been rallying this year, because the market is anticipating future interest rate cuts and future growth in stock prices as a result of more debt and more leverage, which is a function of low interest rates. More leverage is a function of low interest rates, which would be bullish for stocks in this case. So that's what the market is telling us in a nutshell. But what is the overall bond market telling us about South Africa's economy, long-term growth and inflation expectations? And what we see here is that this yield curve is very much steepening, which means that from the beginning, from the small, let's just say from here, right, all the way, and it keeps going up, right? It keeps going up, which means that interest rates, the longer term the more you move into the long term, the higher the interest rate, which would indicate to us that this is a very healthy economy by these standards, or at the very least, it's not that it's a healthy economy, but it's an economy that isn't anticipating any recession, whereby a recession would happen due to bad economic data. The basic telling us that the economy is not heavily indebted and therefore it is relatively stable. Although other facets of South Africa's economy will tell you otherwise. However, the bond market does not see potential recessionary impacts based on South African economic indicators. However, South Africa's economy, because we live in a globalized economy, every single economy impacts each other. So what might cause a recession in South Africa would be most likely global effects, not necessarily domestic effects, because the domestic market, which is represented by this yield curve, is telling us that everything is good, right? So the economy is stable at the very least. And this is telling us that in South Africa, our potential for recession, as I said, I don't want to sound redundant, but just to repeat, is that we are anticipating much more resilient economy over the short, medium term. However, what would cause a recession in South Africa's economy would be due to globalized effects, which would be due to what's happening in the United States, what's happening in Japan, and our exposure to those particular countries where something might crack. If there's high exposure to certain countries, a specific country that cracks, let's just say Japan cracks and South Africa has high exposure. In fact, it does have high exposure because that makes up most of our imports, most of our automobile imports, countries like Japan and China. And what happens is if something cracks in Japan, it's going to bleed over into South Africa's economy. And if it bleeds over into South Africa's economy, imagine what it's going to do for the rest of the African economy. And this is something to keep in mind when considering the long-term trajectory of the South African rand relative to other more advanced currencies. Okay, so what we're looking at right now is M3 money supply. This is the broadest measure of money supply, or the broadest measure that we could find of money supply in the economy. So in South Africa's economy, this is the money supply growth, right? Percentage change. So the higher the percentage change on this chart means that money is growing, the supply of money is growing. So the supply of money growing is inflationary, and the inverse is true, where a decrease in the money supply would mean that liquidity is being drawn out of the economy, which means fewer rands are chasing the same amount of goods or services, assuming it remains the same, ceteris paribus, which is an economic term just to say that in this example, we're saying that if the money supply goes down, ceteris paribus, meaning that all things remain equal, where in this case, we're talking about goods and services, we're assuming that they remain the same. The overall impact of a decrease in money supply would be deflationary, would mean consumer prices would go to the downside. So a money supply decline is not just deflationary, it also means that there is serious problems in the system because banks are not lending this money. Banks are actually drawing supply of money. In fact, what is happening in April and May, what we can see here, these small decreases happen very, very rarely. So every time we see a decrease in money supply, we should take serious warning to it, because it's telling us that banks are actually borrowing less money in the system, which means if debt is the primary driver of economic growth, that means that less debt that is in the system, less money that is in the system would push down prices, consumer prices would push down productivity in the economy, which would mean that employers would be less likely, less willing to hire more employees. So this is trickling down to unemployment, right? Now, this means that unemployment is going to be on the rise as a result of the lack of money supply in the system, right? Conversely, a higher money supply as a function of bank credit would increase productivity in the economy. And as a result of new productivity in the economy, we would get more jobs, everything would be smooth sailing, right? So these decreases are telling us that there is a crack, although this would run contrary to the yield curve, which is telling us that everything is okay. But the money supply is telling us that, okay, not everything is okay. Maybe something is bad in the system, but it's not really going to cause a recession. So it's not a recessionary problem, but it is a problem nonetheless in the system. And this could also mean that it is a global trend, because global trends are about global money supply trends. Money supply trends around the globe are very much interconnected. South Africa's money supply, what's happening with South Africa's money supply, might tell us bigger story of what's happening around the world. And this might tell us that around the world, there is a decrease in global money supply, which would mean that a potential recession potential globally is significantly high, right? As a result of this. So that is something to keep in mind. Consumer prices, on the other hand, in South Africa are relatively elevated, although we did see a big decline in 2023, right? And then after September 2023, we've just been on a slow rise in consumer prices. So consumer prices aren't really showing us weak signs for the whole year, basically, the whole 2024. Although what has been interesting is what you can see here at the end of 2024 is gasoline prices, and gasoline prices are showing signs that, okay, maybe consumer prices might be on the rise again. And remember, consumer prices lag gasoline prices. Gasoline prices go up, and then that will trickle down into consumer prices, because oil and consumer prices are highly correlated. So when we take the price of gasoline, we are just doing this just to see what consumer are generally spending, and then we compare that to the other goods in the economy, which is in the light I think it's light green, so we can call this light green and maroon. In the maroon line, we have gasoline prices, which are going up, as we can see, telling us that something is happening. Why gasoline prices going up? This could be a result of most likely FX problems, which would mean that in the same period in 2024, South Africa's rand has been losing value against the United States dollar, which is telling us that something is cracking in the financial system, not just in South Africa, but around the globe. And this might prompt central banks around the globe to start cutting interest rates, right? To start cutting interest rates. So that is something very interesting that we should pay attention to. It is telling us that there are fundamental weaknesses in the global economy, although what is happening in South Africa is that this gasoline price going up is absolutely killing the rand. And what's going to further kill the rand is if we get CPI numbers next month, South Africa's CPI numbers, if we get higher than expected numbers, that would kill the rand even further. So over the long term, over the next few weeks, we should be anticipating a weaker rand in anticipation of what's going to happen with the interest rate decisions. And if they cut interest rates next month, then that would further reduce the value of the rand, because lower interest rates decrease the value of the currency. Higher interest rates increase the value of the currency, because it's more expensive to borrow in that currency. So if interest rates go up, it is more expensive to borrow rands, which means that the value of a rand goes up because of that logic. Interest rates is the price of money. that is what we should keep in mind. So now, what we see here is very interesting. Labor force participation rate versus unemployment. On the left, we have South African labor force. This is in South Africa's on the left. On the right, it's the United States. And if we look on the left, right, South Africa's unemployment rate is very much weird. It's a relationship to labor force participation rate, because in a healthy economy, right, if unemployment is going up, what you'd also want labor force participation rate to go down. So if you look on the right, in the United States, what happened in 2020, if you can see this dramatic decrease here on the right, what happens is labor force participation in gray goes down during the pandemic. So less people are participating in the labor force because they're forced to stay home, which means labor force participation rate goes down. It absolutely crashes. And simultaneously, because of labor force participation crashing, unemployment skyrockets because less people are in the labor force. That makes a lot of sense. So the lower the labor force participation rate, the higher the unemployment rate, because less people are going for jobs. Now, in South Africa, in a very much parallel universe, let's call it, what we are seeing is labor force participation during COVID went down, but the unemployment rate went down as well, which is very, very weird when you consider the fact that why did unemployment rate go down during COVID? A lot of reasons, mostly basically the government hiring, increasing the amount of jobs in the economy, the amount of government jobs, due to the fact that COVID needed massive response. It needed massive medical, it needed massive medical attention, it needed massive healthcare workers. So there was a huge spike in healthcare work relative to the rest of the economy. Now, that still doesn't explain the decrease. So the decrease might be caused by multivariable effects, which we can discuss in a separate session that we'll have in the future. But what is interesting is that unemployment rate also, when it recovers, when labor force participation goes up, unemployment rate goes up. So that is very, very weird. So South Africa's labor force participation rate, which is why South Africa's economy, its labor market is broken, which is why a lot of people are struggling to get jobs, because if more people are participating in the labor force, it's not necessarily going to increase the amount of employment in the system. In fact, if history shows, if this chart is any predictor, it will tell us that if more people are participating in the labor force, that is only going to increase the unemployment rate in South Africa, because when more people are participating, when more people are looking for jobs, and there's no jobs at all, if more people are looking for jobs, that's going to file a lot of people as unemployed, because a lot of people are looking for jobs, but they cannot find these jobs, which means the level of unemployment in the economy would go up, which again shows you why the unemployment number is a lagging indicator. It's not a very good indicator of the health of an economy, especially in South Africa, where you have a completely broken labor market, right? Whereas in the US, the labor market is doing all right, to say the least. Now, what does this mean for interest rates? If we can see here, this is interest rates around the globe, right? US interest rates, South African interest rates in the blue line of South African. And what we'll notice here with this chart is that interest rates in the global economy move the same, right? So if we can see, let's just say in one country, interest rates, they start cutting interest rates, but in other countries, they haven't started cutting interest rates. They've kept interest rates unchanged. We can use that country that took the first step as a reference to what other central banks might do in the future. This is why this chart just proves how interconnected these economies are, because these interest rates go up at the same time, indicating to us that economies are intertwined, economies are interconnected. Good economic data in the US is most likely going to positively affect the economy in South Africa. Vice versa, if we get bad economic data in South Africa, the potential, the probabilities that we'll see bad unemployment data in another country is significantly high because our economies are interconnected. And our interest rates are interconnected because our central banks are trying to avoid a carry trade between these currencies, right? It's also for stability, currency stability. So if you see here what's happening, let's just say in maroon, we have euro area interest rates. And what we can see is euro area interest rates are significantly lower than interest rates in other economies, which means there's a carry trade here, which would mean that the euro is basically a dead currency just from the fact that it is basically getting killed by these other economies because interest rates in those economies are higher than interest rates in Europe, which means there's a carry trade because you can borrow euros and then place those euros, go in the FX market, swap those euros for rands, and then go into the South African market and buy a bunch of South African stocks, which will earn you a higher interest because interest rates in South Africa are higher than interest rates in Europe, which is the carry trade. So as an economy, you don't want to have you don't want to have the lowest interest rates in the world. So when central banks are cutting interest rates, they are keeping in mind what is happening with interest rates around the world, not just in their own country. But what we see in orange is very interesting. In orange, we have interbank rate. So this is the global interbank rate. It just says US interbank rate, but this is the LIBOR interbank rate. And this is telling you what global banks, the banks that are responsible for credit creation and money supply in the entire globe, it's telling us that these banks are seeing significant drawbacks in the levels of in the fact that they might cut interest rates. Central banks around the world are starting to cut interest rates. And what we can see here is that in black, Great Britain has already cut interest rates. So that's telling us, is South Africa going to cut interest rates soon? They have to cut interest rates because the global trend is heading towards interest rate cuts. So an interest rate cut is likely imminent based on this global trend, what we see right here, right? This is telling us, this little piece right here is telling us that, okay, interest rates are going to have to be cut sooner rather than later. So this is very, very interesting, and we should follow this carefully. This means that South Africa's economy might be worse than what it looks like, but mostly it's telling us if South Africa cuts interest rates, it'll be because of the global trend towards interest rate cuts. This would be the key reason why South Africa would cut interest rates, amongst many things. Maybe the economy itself is doing bad in South Africa. So this is all to say that the rand over the foreseeable short term should be low relative to the dollar, although with other currency pairs, you'd have to check the interest rate differential between these two countries. Let's say you want to trade euro ZAR, then you would have to look at interest rates in Europe, interest rates in South Africa. The interest rate that is higher is the interest rate that has more power in terms of long-term trajectory. And this leads us to the end of our session. Any questions, guys? We'll have 10-15 minutes just to get the questions. And guys, when you want to trade USD ZAR or ZAR currency pairs, please use AccuMarkets. AccuMarkets is an amazing broker for this type of function, this type of trading. So please, the link is above on our chats, right? We'll just try to get this pinned, right? Let me just quote this for you guys here. Okay, so I hope everyone can see that. That is our AccuMarkets link. So any questions, guys, feel free to ask your questions in the chat. We will address your questions to the best of our abilities. Let me know what you think, guys. Let me know if you enjoyed the session. What did you get from the session? Okay, so if our interests are high, then yes, USD ZAR will drop. USD ZAR will definitely drop. However, that is to say that it will only drop. You should keep that in mind when it's an interest rate decision, let's just say. So it's not like it's going to drop on any given day. it means that it's more biased to drop. But also, if let's just say South Africa's interest rates are higher than US interest rates, and it means South Africa has the higher ground, right? It has the higher ground. But also these banks must be willing to the link is just here. Let me just quote it again. Let me just type it here so you get the link. Okay, so yeah, let me just paste that there. There we go. Okay, so I see a question. So, okay, yes. So it's more like it's more or less where the interest rates will drop. It's more like if we get news, if we get something, if we get news that says, okay, interest rate news come out, if we get interest rate news coming out, and then the rand interest rates in South Africa are higher than interest rates in the US, and let's just say they keep interest rates the same, then we should anticipate that the rand is going to gain value over the dollar. So USD ZAR would drop in that scenario. If they cut interest rates, USD ZAR would go up, right? Even though interest rates in the US are lower than interest rates in South Africa. However, this is to help us guide us if they leave interest rates unchanged. If they leave interest rates the same, then which one is higher? South Africa's interest rates are higher, so most likely the ZAR would gain ground against the US dollar in such a scenario. If they hike interest rates, the ZAR would gain ground against the US dollar likewise. Okay, let me just see. Question. Global interest rate domestic lending. Yes, percent up here. So if interest rates are high, does that mean more investors are putting money? Not necessarily. If interest rates are high, that means that they're trying to make it more attractive for investors. So let's just say we are in South Africa. I'm a South African investor, and interest rates in South Africa are higher than interest rates in Japan. This is going to attract a lot of Japanese investors into South Africa for that specific reason, but not all the time. Not all the time. Because also you have to consider the fact that risk is a big piece of the puzzle, right? Even though interest rates, like let's just say, look at Turkey. Interest rates in Turkey are extremely high. Interest rates in Zimbabwe are high. But is anyone going to put their money in Zimbabwe just because interest rates are high in Zimbabwe? Of course not. Of course not, because of the underlying fundamentals of the economy. There's structural issues in an economy like Zimbabwe, in an economy like Venezuela. So it doesn't matter how high the interest rate is, it wouldn't be useful to invest in such an economy, right? But if you're comparing the US and Japan, interest rates in the US are higher than in Japan. As a Japanese investor, you go to the United States and invest in the United States, which is why the currency would benefit the United States, because more people are invested in the United States from Japan, from the foreign countries where interest rates are lower. Okay, I hope that makes sense. Okay, so if interest rates are high, does that mean more investors are putting? Okay, I think yes, I answered that question. Okay, we have a question from Abdul Malik. I've been backtesting economic data and came to the conclusion that US inflation rates is a leading economic indicator and is positively correlated with US interest rates and also crude oil prices with interest rates. 100%. In conclusion, is it safe to say crude oil prices are number one? I would 100% agree with that. Crude oil is a leading indicator. If you want to see indicators for the economy, if crude oil is going down, the economy is doing bad. Even though unemployment won't say that the economy is doing bad, it will say maybe 5 months in the future. But if crude oil is doing bad, the economy is doing bad. 100%. Crude oil is a leading economic indicator. It's not the number one leading economic indicator, but it is one of the leading economic indicators. I hope that makes sense. Let's just see. Why is it a bad thing when interest rates go low? Yes, interest rates. Okay, that interest rates, let's think about this. Interest rates is the price of money. So the lower the interest rate, the cheaper money is. So if South African interest rates go down, then South African rands have become cheaper, which means that it's going to stimulate the economy by pumping more money into the system through debt, which means if more debt is being handed out, the money supply expands. So more money, supply and demand. If there's more supply for the same amount of demand for that currency, what happens to the value of that currency? It goes down. So if you get more of something, the value goes down. Scarcity drives the price up, and abundance drives the price down. If there's an abundance of something, prices go down. So the price of currency is interest rates. Interest rate is the price that you pay for a currency. It's the price tag of the rand, it's the price tag for the euro, etc. I hope that makes sense. Okay, global recession is just when there's a meltdown in financial markets, when you see S&P 500 going down 50% and the economy is in a panic globally. Every single economy is in panic. That is a global crisis, recession. So if you have GBPs and the market is selling, does that mean our currency is getting more power or what? Yes, it either means the currency is getting more power or the GBP is doing bad. So, or it's both, 100%. Yanga, thank you for the comment. What will happen if central banks in the US decide to pause, drop, or hike interest rates? So if the US drops interest rates, the dollar loses value. If interest rates go up, then the dollar gains value. If interest rates remain the same, then we'd have to really consider the currency pair. If it's USD ZAR, if it's USD ZAR, it's the same thing, right? We're thinking about the same thing. The same thing will happen, carry trade, etc. What we've just said. Okay, your thoughts on gold. Unfortunately I do not have any thoughts on gold. I haven't been on gold for the longest of times. But yeah, gold, that will be very, very interesting. Euro JPY. I'm really mostly focused on Japan. So Japan is a very key component of Euro JPY. So it will be very interesting what the Japanese central bank does. Will they hike interest rates? I think they're going to keep interest rates the same. Everyone is cutting interest rates. Why would they hike interest rates? So, and how long can they hike interest rates if they do decide to hike interest rates? Japan is the most heavily indebted nation in the world. It has the highest debt to GDP of 280%, which is the highest in the world. So imagine the debt in your economy is 280% of GDP. That is ridiculous amounts of debt. It is unreal amounts of debt. So that is very interesting. So guys, please do check out the AccuMarkets link that we posted on the group on the chat, right? Very, very interesting. Just make sure, guys, make sure you're using the best broker SA so you can ensure smooth trading, guys. Okay, let me just repeat carry trade and then we'll end the session. So carry trade is basically, let's just say South Africa has interest rates at 8%. The United States has interest rates at 10% or at 8%, or let's just say the United States has interest rates at 5%. Now, South Africa's interest rate is 8%, US interest rate is at 5%. Interest rates in the US are lower than interest rates in South Africa, which means that when you, it means that it's more, it means if you, an American is thinking to themselves, I can earn 8% in South Africa, whereas in America, I'm only earning 5%. So I'm going to go to South Africa, I'm going to borrow money. No, I'm going to borrow money in America in US dollars at 5% interest, right? I'm going to borrow at 5% interest. I'm going to use that borrowed money and then convert it into rands, which would increase the exchange rate of the South African rand. And then what's going to happen is, remember, I have debts at 5%. I'm going to take that money and then I'm going to invest in South African assets and I'm going to earn 8% so that I can pay off my 5% interest rate in America and then keep 3%. So I make 3% profit. That is a carry trade. So a carry trade basically has that impact on these currency pairs. It means that the South African rand is going to go up relative to the United States dollar. That is basically a carry trade. Okay, so guys, thank you so much for the session. That's it for me. I'll just hand over to Mr. Ben for final words. Shaya.
No, indeed, absolutely beautiful, bro. Beautiful stuff, guys. Sorry about that. It's been an epic session, and it's been quite insightful, not only that, it's an eye opener because remember, most of the time we've been really rather looking at the foreign markets, We've been looking at the foreign markets, seeing what the US is doing, the euros, each and everything. However, now since you guys have suggested, we have now pivoted to looking at the African markets, locally, seeing what's happening, what is really driving our currencies, what is really driving our buying power, each and everything that we have, each and everything that we do, what is really moving the market in South Africa? Because most of the time you just hear, oh, the market's this, the market's that, whatnot. And sometimes, yes, we do relate, but we relate in terms of the US. But now, as we've pivoted to the local environment, it's going to be quite interesting. So, guys, thank you very much for participating. We're going to meet tomorrow for our technical session, and then we're going to meet on Thursday for the fundamental sessions once again. And of course, we are pushing the African market. It's going to be quite interesting. So guys, please do have your pens and papers every time we have the sessions. And ask the questions. We're here to fulfill each and every question that you guys have, guys. Thank you very much for being here. I'm quite excited to be here with you guys. So guys, with that being that, let's close with that. We close with that. Shaya. Power, guys.